2025 has been brutal for investors. Inflation's eating away at our wallets. Tariffs are rattling global markets. Recession fears are screaming from every headline. And let's be honest, your portfolio is probably drowning in red. SCHD, my favorite dividend ETF, and the one I invest in every single day, is down 6.65% so far in 2025. But it's not alone. The SPY, which tracks the S&P 500, is down over 10%. QQQ, tracking the NASDAQ 100, is down 13.1%. Even DIA, the Dow Jones ETF, has slipped over 8%. The entire market is under pressure. So it's fair to ask, if SCHD is built to hold up in volatile markets, why is it dropping too? We'll get to that because it's a key piece of understanding why this ETF still belongs in your portfolio. In this video, I'll break down exactly why I believe SCHD is still a screaming buy and why I'm not just holding, I'm doubling down. We'll compare its performance to other major ETFs, explore how dividends can steady your portfolio in rocky markets, and count down the top 8 reasons SCHD remains one of the smartest long-term investments you can make. And trust me, you'll want to stick around for the final reason. It's SCHD's ultimate superpower, and it might be the most powerful compounding tool in all of investing. Let's start with why this year has been so difficult. Inflation is still hovering around 3%, keeping pressure on everything from food to housing. New tariffs, especially on Chinese goods, have disrupted supply chains and raised costs. The Fed is walking on a tightrope, trying to tame inflation without tipping the economy into recession. And consumer confidence, it's at decade lows. Take a look at the market. Sharp sell-offs in January, March, and April. It's the kind of year that tests investors' discipline, but that's exactly when solid ETFs like SCHD can shine. Let's talk about how it's holding up. SCHD is down 6.65% year to date as of April 15th, but here's how it compares. SCHD isn't immune to market sell-offs, but it's holding up better than most. Its focus on quality dividend-paying stocks gives it some insulation. While QQQ and ARK are heavy on volatile growth names, SCHD leans into proven companies like Chevron, Coca-Cola, and Verizon. These aren't high flyers, but they're resilient. And in a market like this, that's exactly what you want. Why does this matter? In a market where everything's red, losing less is a victory. SCHD's 3.6% dividend yield as of April 2025 keeps paying you, cushioning losses and letting you buy more shares at lower prices. Let's tackle the obvious question head on. If SCHD is designed to perform well during volatile markets, why is it down in 2025? It's a fair concern, and answering it is a key to understanding why SCHD still deserves a spot in a long-term portfolio. Here's the truth. No ETF, no matter how strong, is completely immune during a broad market sell-off. When fear takes over the market, investors often sell first and ask questions later. That means even strong, stable companies like Home Depot, Cisco, and Pepsi get dragged down with the rest. Not because anything is wrong with the businesses, but because panic doesn't discriminate. Dividend-focused ETFs like SCHD also face added pressure when interest rates rise. Why? Because when bonds offer better yields, they become more attractive to conservative investors. And when money flows into bonds, it often flows out of dividend-paying stocks, causing funds like SCHD to dip. And then there's the tariff issue. New tariffs, especially on imports from China, are disrupting global trade and raising costs for manufacturers. This hits cyclical sectors like industrials and materials the hardest. And guess what? SCHD leans into those sectors. That makes it more sensitive to global trade disruptions than, say, a tech-heavy fund. So yes, SCHD is down, but here's the context. It's holding up better than most of the major ETFs out there in 2025, including the SPY, QQQ, and even the Dow. While many funds are getting hammered, SCHD is showing real resilience, and that's not a fluke. That is by design. SCHD is built with a disciplined approach. It screens for strong profitability, low debt, and reliable dividend history. Think of it this way. Weathering a storm doesn't mean you don't get wet. It means you stay afloat while others sink. So no, SCHD isn't broken. It's doing exactly what it's built to do. And from here, the case for owning SCHD only gets stronger. Now let's dive into the 8 reasons why I believe SCHD is still one of the smartest long-term investments you can make. Starting with reason number 8, and I'll be saving the best for last. Number 8, SCHD is built for stability. When markets start falling apart, SCHD doesn't flinch. It's built to be a fortress. Every stock in this ETF is handpicked based on strict criteria: return on equity, dividend consistency, low debt, and strong profitability. No flashy gambles here, just dependable businesses that have proven they can thrive through all kinds of market cycles. And when things get ugly like they have in 2025, these solid cash-generating companies are better positioned to keep paying dividends and hold their ground. That's what makes SCHD a foundation, not a flyer. Number 7, it avoids the hype. SCHD has low exposure to mega cap tech, which means it doesn't ride the same highs, but also avoids the deep crashes. Instead, it leans into sectors like energy, consumer staples, healthcare, and industrials. These sectors tend to hold up better in downturns and provide a balance when other parts of the market get shaky. Number 6, low costs that compound over time. SCHD has an incredibly low expense ratio of just 0.06%. That means for every $10,000 you invest, you're only paying $6 a year in fees. Compare that to many other actively managed funds or even some ETFs that charge 10 to 20 times more. Over the long term, those savings really add up. Number 5, tax efficiency and taxable accounts. Most of SCHD's dividends are qualified, which are taxed at the long-term capital gains rate, often 15% or less. If you're investing outside of a retirement account, this is a big deal. You're earning reliable income without getting hit with a huge tax bill each year. Number 4, reconstitution keeps it high quality. Every March, SCHD's underlying index is refreshed. That means underperformers are removed and companies that now meet the strict screening criteria are added. This process ensures the ETF stays aligned with quality and avoids stagnation. It's a built-in upgrade system. In fact, SCHD recently added strong names like ConocoPhillips and General Mills, showing how it evolves with changing fundamentals while staying true to its core strategy. Number 3, valuation friendly in 2025. SCHD currently holds undervalued dividend stalwarts, trading at compressed multiples due to the broader market decline. You're buying high quality names at a discount and also getting that 3.6% dividend yield while you wait for prices to recover. That's rare in today's environment, and historically, buying quality companies during periods of fear and low valuations has been one of the most reliable ways to outperform over time. Number 2, it works for every stage of life. Young investors benefit from the power of reinvested dividends, while older investors can rely on the ETF for income. SCHD fits nearly every investment objective: accumulation, income, or preservation. Its versatility makes it a go-to choice in both Roth IRAs and taxable accounts. Whether you're 25 or 75, SCHD offers a mix of safety, income, and long-term growth that aligns with just about any financial goal. Finally, the moment you've all been waiting for, the number one reason SCHD stands out from the crowd, its ultimate superpower, and that is consistent dividend growth. This is where SCHD truly separates itself from the rest. Over the past 10 years, SCHD has averaged a dividend growth rate of about 11%. This is what turns a good ETF into a long-term wealth machine. Dividend growth isn't just about a larger payout. It's about beating inflation, compounding wealth, and creating a self-sustaining income engine. Let's say you start with $10,000 in SCHD. At 3.6%, your initial annual income is $360. If dividends grow 11% per year in 10 years, you're earning over $1,000 a year without adding a single extra dollar. If you reinvest those dividends, that income stream accelerates even faster. During market downturns like 2025, dividend reinvestments buy more shares for less money, amplifying your long-term returns. And over decades, this snowball becomes an avalanche. It's powerful, it's consistent, and it's the reason I invest in SCHD every single day. Despite being down this year, analysts are still positive on SCHD. Morningstar gives it a 5-star rating, citing its quality-focused approach, low turnover, and high income reliability. Goldman Sachs estimates 7 to 10% annualized returns over the next decade, thanks to strong dividend yield and modest price growth. And while some experts warn about sector-specific risks if the economy weakens further, most agree SCHD is far better positioned than many of its peers. Since January 1st, 2024, I've been investing $5 every single day into SCHD. That small, consistent habit has already added up to about 90 shares, and I'm just getting started. That's the power of consistency. Even at $5 a day, you're putting in over $1,800 a year automatically with zero stress, and I have no plans to stop. And right now, I'm going beyond that daily $5. I've been adding more shares to my retirement account, especially while SCHD is trading at these low prices. This is how wealth is built: steady contributions, long-term conviction, and taking advantage of opportunities when others are scared. SCHD isn't the flashiest ETF. It doesn't chase the hottest stocks, but it delivers through market storms, inflation spikes, and economic slowdowns. It makes up about 30% of my portfolio because I trust it. I trust the process, and I know that over the long term, SCHD will reward those who stay consistent. Thanks for watching, and check out this video right here, and we'll see you in the next one. So I see you in the next one. Let's say it together.